Very first Yahoo Finance Premium webinar, Trading Stocks and Managing Risks in the COVID-19 Era. We're coming off the best quarter in over 2 decades, and that's after falling into a bear market the quickest in history. I don't think anybody saw this coming. The explosion in volatility has presented challenges for retail and institutional investors alike. Even the pros are having a hard time with this, guys. And we're going to talk about how to navigate this very difficult environment. To help us, we're soon going to be joined by Brian Shannon. He's a chartered market technician and also the founder of AlphaTrends.net. If you follow me on Twitter, you know his name because I retweet his stuff all the time. And we're going to be doing some Q&A with him that you can join in on. And we're also going to be demonstrating some of the features of our premium service, how you can use it to analyze your portfolio, fine-tune it, and incorporate trade ideas for individual stocks that our premium service highlights every day. Now, some housekeeping notes. We want to let everyone here know that you can interact with us in real time, and here's how. We're using the Blue Jeans secure video conferencing platform, which is now part of Verizon, and we're going to be running polls throughout the course of the event. Now, you can see these on the right-hand tab of your screen, and you can also chime in with questions, and you can put these in that very same right-hand tab. You can do them anonymously, or you can choose to use your name. Also, on the bottom left-hand side of your window, you have some viewing options. There's a slider where you can size the presenting screen, as well as the video boxes for both me and Brian. Now let's get started. And let's do something interactive here, because I want to know what you guys are about. So how long have you been trading? Is it less than 1 year? Is it 1 to 3 years? Is it 3 to 10 years? Or more than 10 years? And as you guys are voting, and again, that's on the right-hand tab of your screen, I want to bring in Brian Shannon. First, thank you for being here with us.
Thank you, Jared. Good to be here on your first show. I'm honored.
You bet. This has been an incredible trading environment, the record volatility that we've been talking about. You've been around for a few of these cycles, the dot-com bust and boom, the real estate bust and boom, great financial crisis. How does this compare, and how have you adjusted your trading?
I think that experience, it means a ton in this environment. I mean, the way that we came down so quickly was, I think, justified. But the way that we rallied back to try to get your head around what we read in the headlines versus what price action is saying, I think there's, for a lot of people, a real disconnect. And it shows the importance of being flexible and really listening to the price action, not fighting the market and saying, well, this doesn't make sense, so I'm going to short it. That has been a very costly endeavor for anyone who's tried it here recently, as we're, pretty much at all-time highs in the NASDAQ and S&P 500, not too far behind.
Yeah, and it's pretty interesting. A lot of the pros, like from Stanley Druckenmiller to Warren Buffett, kind of got the timing on a lot of this stuff dead wrong, and they've come clean, but it just goes to show you, you have to have a plan where you can manage your risk. And could you talk about how you've developed one and what works for you and maybe what works for some of the beginning traders?
Yeah, great question. And I think it boils down to time frame. So Warren Buffett wasn't able to adjust because his time frame is so long term that the markets moved quicker than he was able to. And even Stanley Druckenmiller, who's, somewhat notorious, I guess, infamous, whatever you want to call him, for being an aggressive trader, maybe the handwriting on the wall wasn't there for him either. There's no shame in that. Every one of us underperforms at some time, whether it be a bad stock idea or, just our general assessment of the market. The key is to not fight the market. For me personally, my preferred time frame is what I think, which is why it's my time frame, is the best one to have, which is a swing trader. So 2 days to maybe 2-3 weeks is generally the maximum that I hold a stock, and I leave it up to the market to tell me, so I have a backup plan on each and every trade.
Yeah, I'm just looking at some of the polling results as they're coming in. So it looks like 42% of the respondents have less than 1 year, 16% 1 to 3 years, 17% 3 to 10 years, and then 25% more than 10 years. So it sounds like we got some advanced traders in here and some people in the middle, but a lot of people who have just been in this game a very short period of time, less than 1 year. Not surprising, because a lot of people just started trading because sports gambling went away. And there's that interesting parallel there. But the two styles are very different. So what do you tell people who are just getting into the game now to prepare them for not only a volatile market now, but what could evolve into something hopefully much calmer in the future?
Well, I think that, it actually surprises me that 41% are, less than a year. We hear about the Robinhood and all that, but, the good news is that those people are looking, reaching out, looking for education, looking for news. So I applaud them for that, number one, for being on this call, and hopefully we can provide some value for them to learn. I'm going to go back to the point I made in the previous comment, which was, know your time frame. You can't compare yourself to Warren Buffett if you're sitting there trying to day trade the stock of the day. Also, if you're trying to day trade the stock of the day, keep in mind who you're up against. You're up against some of the sharpest minds on the planet, the best programmed computers there are out there, and even Jim Simons of Renaissance. Their fund is down, and they are the ultimate short-term quant fund. So cut your losses. Risk management truly is job number one. If you look back at the decline we saw in the first quarter of this year, and you can't stomach something like that again, imagine yourself being in that position. What would you do differently now? How can you learn from that waterfall decline? I'm not saying we're going to have one again, but always be prepared for it and recognize what your preferred time frame is.
Yeah, well, we're looking at a chart of the Spider S&P 500 ETF, the SPY, my favorite. It's in my Twitter handle. And let's just take a look and kind of break down what's happening right now.
Well, obviously, from the March 23rd low, we had an immediate rally, and then we showed a higher high with that higher low. So at that point, really at the beginning of April, about the 8th of April, we had that higher high with a higher low, and now we're back above the 50-day moving average, which is rising. We're above the 200-day moving average. That's that longer, flatter one. And we just today are back above the volume-weighted average price anchored from the high of June. That's important because it tells us, the volume-weighted average price, it tells us the average price from that peak has been declining, but now since that event, since that peak, the average long participant is now making money, whereas the average short is losing money. So a lot of people are, looking to bet this market is going back down, but the evidence simply doesn't support it. The average price from the highest point this year, since the recovery, is now in a winning position again. So the buyers are in control. To fight it is a foolish event. I think that 300-ish level, let's say 295 to 300, if we get and hold below that, then we might have an issue. But for now, the worst you can say is neutral. But longer term, I mean, we're still in an uptrend. So I just would suggest not to fight that.
All right, we're going to do a little bit of Q&A here. This comes from Alex Wallace, one of our senior leaders at Yahoo Finance and at Verizon Media. She's asking why the disconnect between the COVID news and the market in the last 2 weeks. We've seen all these headlines that have been so negative. They've gotten slightly more positive, and we did see the market sell off on some of them, but really just shrugging off a ton of bad news right now, Brian.
It's a great question. I don't think there's anyone who can really answer it and have a great answer that makes complete sense. For me, it's about, again, only price pays. So I look at the market and say, the market is a discounting mechanism. It discounts what's already happened, and it anticipates where we're going to be with the economy 6 to 12 months down the road. So maybe the market is looking at some kind of recovery down the road. A really fun little phrase that I heard, I don't remember where I heard it first, but it is that if you trade off the headlines, you'll soon be delivering the news yourself, meaning, newspaper route. You'll be broke delivering the newspapers because there's a lot of disconnect between the headline and price action. So, look at price action, and if it doesn't make sense, at least just stand to the sidelines. Don't try to fight it. You'll get run over, and it'll be a very expensive lesson.
Yeah, I think a lot of portfolio managers who use strictly fundamentals could greatly improve their results simply by looking or learning technical analysis, because in the current environment, nobody knows the fundamentals. Companies have withdrawn their guidance, and that's going to come back. But looking forward, all we have is the prices in the market that are in front of us right now. And there is that huge disconnect. And we talk about this a lot at Yahoo Finance, that markets are forward looking. But I'd add to your great response that we have $8 trillion in fiscal stimulus globally, $10 trillion in central bank stimulus, the old adage, don't fight the Fed. There's a lot of money being thrown at this problem. And it's possible that the markets will roll over. And I don't see us going to test the lows, but I think it's going to be a very difficult and frustrating market to navigate for a lot of people. We're going to see a lot of chop, and we're in the summertime where there's low liquidity and low participation. This could be dragged on over the next few months. And then I think when we finally do return to normal and markets are somewhat more rational, people are still going to be skittish the same way they were in 2009 and 2010. They're not going to believe the bull market is here, just the same way a lot of people don't believe the current market is a bull market, and history will decide that. But I want to move on to another question now, and this comes from one of our viewers. Do you hedge your positions in this market? As you said earlier, current market action is not logical. So if you're long the S&P 500, do you hedge against that? And finally, can you give us some color on Tesla stock? It's more valuable than Toyota Motors, and that is a true statement. So let's take the beginning of this. Do you hedge your portfolio if you're sitting on some, let's say you're a long-term investor, it's summertime, you don't know what's going on. Do you hedge? How do you do it?
Great question. And honestly, Jared, it's not my area of expertise. My area of expertise is my hedge is my ability to get in and out quickly as a swing trader. So I feel like I would be leading someone astray if I could recite a bunch of stuff I've read, but I don't practice myself. So my feeling is, again, if you can't look at the market and see what happened in February and March, and if you're comfortable holding through something like that again, don't hedge. But if you're nervous about it, figure out a way to hedge that makes sense for you personally.
Yeah, very good advice. And it's difficult to do. Some people, the pros tend to hedge in the futures. You have to have futures accounts to do that. You could buy an inverse ETF to SPY that comes with its own difficulties. Right. You could buy options. So you really have to, this could be an entirely new seminar. But I'm going to move on.
Sell options too. There's
yes.
Tons of strategies out there, but I'm pretty much directional bet. I prefer the upside trade. I find short selling is a lot more difficult, even in a bearish environment. So just know your time frame and seek out that qualified response from someone who can really shed more light upon it than me.
All right, Brian, thank you. We're going to bring you back in a little bit. I want to move on now so that we can demonstrate our premium product, and I'm sharing my screen. Here we go. Give me 1 second. And boom, you guys should be able to see this. All right, so this is the dashboard. This is what you're going to see when you log into Yahoo Finance and you're a premium member. And my watch list is a portfolio that I just put together without too much thought last July. And it turns out that it's doing better than the S&P 500, which is the benchmark here. We can see portfolios up 15% versus down 4% for the S&P 500. And you can get some different, I would say, metrics on your portfolio in terms of valuation, diversification, risk level. We'll take a look at that in a second. And I'm going to scroll down the page and go kind of quickly because I want to save time to get into and analyze some of the individual investment ideas in this seminar because that's my favorite part. But here we have some of those investment ideas. You'll see those here. We have research reports on various stocks. We have an estimation of fair value using the Peter Lynch valuation method of stocks that we have in the portfolio and that I follow. That could be overvalued, fair, undervalued. And then scrolling down a little bit more, we have company outlook based on some leading indicators. And these are dividends, innovation, hiring, sustainability, insider sentiment, earnings. And these are different for each stock that we look at. And then we have technical events. These are particularly useful if you're trying to get into a stock, out of a stock, and especially for the short and medium-term traders. And we're going to be taking a longer look at those in just a little bit. I want to now take a look at the diversification feature here, because this is pretty interesting. It's going to show you how diversified your portfolio. So here is my portfolio, and here's the fair value estimates that we were talking about before. And we can look at this in a heat map, and then we can group, for instance, by sector. First, I want to point out that I have huge positions, theoretical positions, in Alphabet, Apple, Amazon, so very much weighted to tech and the growth stocks. But if we sort by sector here, we can see a lot of communication services. That's going to be Alphabet. Facebook might be in there. Consumer cyclical, that's probably the Amazon position. And then just scrolling up again, this will show you your risk profile. And this is based on the notion of alpha and beta. Beta is how much your stock moves relative to a benchmark. So let's say the S&P 500 goes up 1% and Apple goes up 2%, it will have a higher beta than a stock that's not moving as much as the underlying index or benchmark. We also have a measure of volatility, so you can track that in real time. And you can see the valuation of this portfolio, or the volatility, really shrunk into the turn of the year, but then accelerated with all the COVID headlines. And it peaked right at the end of March, which was actually the bottom, or just around the bottom, in the stock market. All right, so we're going to move on for a little bit here. And let's take another poll. And this one is going to be, how do you select markets or stocks to trade? Is it based on technicals, fundamentals, advisory service, could be paid, could be free, and then social media. So that might be Twitter, might be some Reddit room, and you can select more than one of these, and we're going to come back to that in just a little bit. So let's take some audience questions, and I'm just going to look at a couple of these, so give me a second, and then we'll bring Brian back in. All right, here's one about Warren Buffett. I've seen Buffett recommend index funds, and you mentioned the SPY and S&P 500. Are there any other index funds that we should consider? I'll just throw out, there are lots of index funds. You want something with a lot of liquidity, a lot of volume so that you can get in and out if you want to, but there are ones by Vanguard that track the S&P 500 just about exactly the way SPY does. So I'm not tethered to SPY. It just happens to be one of the first here. And then here's another question. Can you give us some idea about swing trading? And I'll bring in Brian for this. What parameters do you commonly use for various technical indicators? And Brian, I know you were analyzing XLF and some other stocks, so we'll go through that as well. But I just want to get your firsthand reaction. What are the parameters that you're looking for in swing trading, Brian?
Well, I think that swing trading, you want to be, mainly technically driven. There's nothing wrong with knowing the fundamentals of the company, and sometimes it'll give you a little bit of confidence, maybe to, size up or something like that. For me, I think that what you want to do it using multiple time frames. So for instance, I'll look at a longer term time frame to, one, identify a bigger picture trend. So I'm looking at a bigger picture uptrend, and then I want to see maybe a pullback in that. And what I'll do at that point is look to maybe a 30-minute time frame, meaning each candle is constructed using 30 minutes of data. I'll typically go back about 20, 30 days on that, and that helps me decide my risk reward. Where does it make sense to get involved in the stock once it makes a short-term higher high? And then if I'm wrong, where do I then put my stop to make sure if the market doesn't agree with my assessment, that any loss that I have will be a small one. Third, I look at a shorter term time frame, let's say 5 or 10 minute candles, and that will go back 5 to 10 days basically. And that allows me to just kind of fine tune my entry. I'm a full-time trader, so I'm sitting at my screens and I have the ability to make quick decisions. But that's the way I do it, is multiple time frames. Start with the bigger picture to identify the time frame. Second one to determine your risk reward, and the shortest time frame to fine tune the entry.
Gotcha. So let's look at a real world example. I'm going to share my screen again, and we'll start with XLF. That's the S&P 500 financial sector ETF. And let's go back a little bit more. So we're going back basically a little bit less than a year. We got some moving averages on here. We got another anchored VWAP, and we'll get into an explanation of that in a second. So what are we looking at? And what are you looking
here,
for?
The waterfall decline in March has not nearly come up as much as the rest of the markets. We've got the semiconductors almost at all-time highs, the biotechs, but the financials, we ran right up to that 200-day moving average, and that's why we have a 200-day moving average on our chart, so we can see levels like that. It found supply there and dropped right down to the 50-day moving average, Jared. I mean, it's just textbook moving averages in here. So right now we're sitting on that purple 50-day moving average, and then the blue line below that is the volume weighted average price from the March 23rd low. So what that signifies is the average price since the low is basically right here. If you're about break even, if you've been dollar cost averaging in since that low, that puts it in a really precarious position. Now, I think we're likely to continue to stabilize in here and maybe drift higher. But if this market breaks down below 22.5 and stays below it, financials might be in bigger trouble than we realize. Clearly, looking forward, as the market does, it's saying the banks might have more problems than technology or, a stronger type of group.
Yeah, and that brings up an interesting point that I don't want to spend too much time on this, but it's important. So relative strength, you talked about financials being weaker than the broader market, which would be the S&P 500. Do you ever make trades in markets that have low relative strength that are not outperforming, or do you look for those that are outperforming, like tech in this environment?
Sure. I mean, so it's kind of a tricky question in that it depends on the timing. So we had a period there in mid-May to the beginning of the June where the financials were really ripping higher. And during it, for a swing trader's perspective, during that time, if I can catch a piece of that move, then I'm interested in them. I'm not one of these guys who looks at a relative chart, divide the XLF by the SPY to see which one's outperforming. I look at things on an absolute basis. If I can determine a low risk, high probability trade in the long direction, it might be that a group is starting to play catch up, and I'll go based on the action of the individual name rather than some kind of perceived relationship that may or may not always exist.
Gotcha. Well, I want to move on to another stock that is on your hit list, and this is Chegg. This is an education play. It's a COVID play. A lot of people migrating to online learning, distance learning now. What are you seeing in this stock?
Well, here's a stock that's yeah, I mean, we're up near all-time highs. It started to consolidate a little bit, so it's a perfect pattern of higher highs and higher lows, Jared. And what I look for is 4 or 5 days ago, we had pulled back and then started to consolidate sideways for a day or two, and now we're breaking higher once again. So after a period of consolidation, I'm looking to buy. A lot of people say, buy the dip. I don't like to buy on the dip as it's pulling back because it exposes me to risk that I don't know if the dip is going to keep dipping or, so I want to wait till after it begins to stabilize and then moves higher again. So I happen to be long a little bit of this, about $67.80. Here we are, I'm up 45 cents, but it's a start. If I'm wrong, my stop right now is at, it's under today's low, so about $66 per share.
All right, stick right there. I just want to go over these poll results, and this is how do you select markets or stocks to trade. Now, 29% of you guys out there said technicals, 43% said fundamentals, 18% advisory service, and 10% social media. Brian, what's your reaction on this, specifically in terms of selecting trades? Even if you use an advisory service, you got to own your trade, and you have to be able to manage it. So how does that fit into your trading plan, regardless of the method that you use to select these trades?
Well, I think that's probably about as expected. It's good to see that the lowest number is social media. There's nothing wrong with finding an idea there, but then go do the fundamental research, then go do the technical research yourself. Never just look at a symbol that somebody put on there, and just because they're real enthusiastic doesn't mean that it's going to be a big trade. So I'm happy with those results. Personally, again, for my time frame, I'm 95% technical, and then I'll look at some charts. The Market Smith charts, for instance, do a great job of putting all that fundamental information, and Yahoo, of course, has tons of it that I haven't even explored on the premium yet. So I think that, know what you own. That's the Peter Lynch type thing, so that doesn't surprise me. But make sure that, you can blend fundamentals and technicals together. I think you're going to, find that your results get a lot better than they may have been in the past.
Yeah, well, stick around. We're going to now take a look at some of the investment ideas that we generate through Yahoo Finance Premium in both the technical and fundamental arenas. So I'm going to share my screen again, and you will be on my landing page. Here's a dashboard. Once again, we're going to click on investment ideas, and this will lead us to some recent options. So this for Micron and Shopify, these are going to be fundamental based ideas based on the research of Argus Research. So if I click on this, it's going to say the outlook is bullish for Micron, has a long-term target of 65. You look at the current price, 49.88, so you have a 26% upside. And then you have some notes. I'm not going to go through all of this, but based on the last earnings report, Micron just reported a couple days ago. And I'll just add, we're in between earnings season right now, so you're not going to get as many fundamental ideas. But as soon as the big banks kick off in a few weeks, you're going to get a ton of these. And in the meantime, we also have tons of technical ideas. But if you can go through these reports, and so the long-term target is 25, and I'll just pull this up in a chart by clicking View in Chart. And this brings us to our familiar interface here. And so our long-term target, 65, this is going to be above these highs here. And then you can blend the two styles of fundamental and technical analysis together to get in the trade. Now, all of these fundamental ideas, these are long-term trades that you might hold for a year or two, but it doesn't mean that you can't use these ideas in other ways. So if you're expecting this to go to $60, $65, you can take a look at some of the recent price action here. We got two moving averages. We've got the 50 and the 200. This quicker one here is a 50. It looks like it's about to cross over the 200. If price cooperates in a little bit of time, that would be a golden cross. That's another technical event here. And you can see how these two styles blend. So if I'm looking at it from a risk management perspective and I want to put in a stop, I'm probably going to put it in somewhere around $46. That's underneath these recent prices. And I also have the protection of these two moving averages. And then I can calculate my reward to risk ratio. And we'll talk to Brian about that in a little bit and why that's important. But we want to have enough juice in the trade. We want to have enough space to the upside, since this is a long trade, that if we got stopped out to the downside, we're here to trade another day. Because if you keep your reward to risk ratio higher rather than lower, you're going to have a lot more attempts, because not all of these investments or trading ideas always work out, as we know as traders. You don't even have to bat 50. You can bat 30, as they do in baseball, and that is good enough if you're consistent. So let's take a look at our main screen again, and now we'll go through a technical idea. And for that, we're going to look at Viacom. And this happens to be a Head and Shoulders top formation, and they have a target of $17.89, roughly $18. Actually gives a range, $17.25 to $18.50. So that's a downside of potential profit of 29%. So if we go to Viacom here, you can pull up the actual pattern by clicking on this midterm bullish and this little, let me just reset this in fact. And I'll show you exactly how this is made if I can. All right, so we have these technical events in a list here. We have this bearish Head and Shoulders top. When we click it, here's the pattern. Here's the left shoulder. Here's the head. Here's the right shoulder. And here's the neckline. And it's at a bit of an angle. A lot of times these patterns aren't picture perfect. That's just the nature of the game. We trade them anyway if they're good enough and the setup is good enough. And we can see that we're actually rallying back into the formation here. That's pretty common when you have one of these formations. But you don't want it to go too far. So in this instance, as a potential stop area. I think 30, above 30, which is above this right shoulder, that would be pretty safe. But I may not want to even go that high. I might put something in the 27, actually the 28 area right here. And just based on our target, again, that's about $18 to the downside. That's going to be in here. That looks fairly reasonable, but if part of my trading style is I take partial profits, I would be looking at this resistance, and you can see it's kind of clustering in here at $20. So as it gets to $20, I might take a little off and then let the rest ride, see if we can get to 18 and change. And Brian, I'll just bring you back in here for a second. How are you looking at some of these trades? Anything you want to comment on what you've seen here?
Yeah, going back to Micron, I like that one a lot, Jared. It's as you said, it's got the 50-day moving average, the 200-day moving average just below it, and near your stop that you mentioned of 46-ish. That's also the volume-weighted average price from that March low. So I think that that's a level that's likely to be defended if it does pull back into that area.
Very nice. I'll just put in that volume-weighted average price right now as we're doing this. By the way, this is a free feature of Yahoo Finance on our platform. You don't need to have premium to do this. We're going to go to the anchor date, which is March 18th. I just looked that up here, and bam, save. And you can see, yeah, that's been really nicely capturing the lows. A little bit of penetration there, a little bit of porosity, but for the most part, it's been respecting this line. So interesting comment there. All right, so let's see what time it is. I think we're going to do another poll. Yeah, so let's do this. The poll is, what's the number one mistake traders make? Is it A, having no trading plan, B, taking on too much risk, or 3, impulsive trading? All right, and in the meantime, we're going to answer a few questions now from the audience, and I'm going to bring Brian back in here. First question is, what is your exit strategy? When do you exit sell stocks? And any expected profit margin on them? And Brian, I think this relates to what I was just talking about before, the reward to risk factor. So again, what's your exit strategy? When do you exit sell? And what's your expected profit margin when you trade, Brian?
Okay, great question. So, generally you want to look for the common accepted reward to risk is 3 to 1. In other words, if you buy a stock at 20 and you think you're going to risk $1, you'd like to see upside projection of 23 or so. Now, that's all subjective to how you look at the chart, of course. It's garbage in, garbage out. But what we want to do is, at least have an idea of what the market can do, whether it agrees, the market agrees with us or not. So for my exit strategy, the first thing I consider is, where am I wrong? So if I see a stock breaks a higher high on a short-term time frame, I want to look at it and say, what's the most recent relevant higher low? Because if it breaks back below that, then my definition of trend no longer exists. So that's where my initial protective stop would go. If I buy the stock, let's say again at $20 per share, and that day I get it to run to $20.70 or something like that, I'll often take a third off. The reason I take that third off is because a lot of times, stocks fail. And I've at least locked in a little bit of gain. So that allows me to deal from the stock in a position of strength on that 2/3 balance. At that point, I'll typically raise my stop up right around to that $20 level. So even if I get stopped out of 2/3 of it at break even, I've taken 70 cents on 1/3 of it, and the overall position is profitable. After that, I might look at the stock and say, okay, I'll take a third off at that 23 level. But then after that, I'll look at it and say, what is the market capable of? None of us knows that. So I want to be able to hold my winners as best I can. So for the time frame that I'm engaged on, I'll trail my stop up underneath the higher highs and underneath the higher lows, rather. As long as it continues to make higher lows on that time frame, then I'll hopefully be able to continue to hold it. You never get out at the top when you have a strategy like that, but it does allow you to maximize the time of the trend at least.
All right, let's look at a real world example here with Tesla. I promised that we'd get to this earlier in the program. It's at another record high today. And just based on what you were saying and the price action here, I'm looking at some consolidation from 900 to 1,000. So where would you put your stops in here, given whatever targets you may have, and what might those be?
Well, so we're at all-time highs, and there's not going to be a natural source of supply. There's no one out there looking to break even any longer in Tesla. So I think you have to look at, again, what's your time frame. So if you're a longer-term investor, maybe you're going to put your stop underneath that 50-day moving average, and maybe not just below that, but the most recent low next to it. So that might take you to the low from June 4th-ish. Which is at about 858. So maybe you'd have your stop at 855. If you're wanted a little bit tighter, I think that the low from last week is probably the place that I would put it, which would be, so that low last week was 937.15. I think you put it about 937, and that way you're not giving up so much gain. The other thing to realize is as I mentioned on my exits, I like to do it in pieces. That way I can satisfy that urge to take some profit and remind myself how smart I am, Jared. But the other point is that you still have some on the table, and you let the market tell you when to get out, because none of us would have predicted, maybe some of us, not me, that certainly the stock is up 18% this week. And it'd be, just 10 years since they came public yesterday, that it would have this 5,400%, whatever it is, rally. So you have to, again, time frames and definition of trend, I think, are the way you would want to handle this.
Yeah, just looking at a max chart here, just an incredible run, especially over the last year or so for Tesla. And I just want to add to that, I really appreciate your sharing your trading method, and anybody listening out there, especially the beginners, there are so many different styles. You have to find your own. You have to have your own rules, your own plan. Ideally, it's written, and you have a trading journal. You review all this stuff, and we'll get into that in a second. But it's not cut and dry for everybody. People have different temperaments, so everybody's going to be a little bit different. So just a couple more questions here, and I think I'm going to just take this one first. What pointers would you look at when investing in an IPO stock? First thing I would say is there is no rush, because most of these guys, most of these new issues undercut their first trading day lows within the first year. I don't have the exact statistics, but it's really, really high. And I've talked to various IPO experts on trading from Investors Business Daily, and one person in particular said you need to wait a minimum of 3 months, which seems to me to be a pretty good guideline. I don't trade these myself, in as much as I don't trade individual stocks, just ETFs and futures. But what are your thoughts on this, Brian, in terms of IPOs?
Yeah, IPOs are tricky. When they first come out, it's incredibly difficult. I don't get involved generally. If I do get involved, Jared, it's a very short-term strategy to start out, and it really uses the anchored volume-weighted average price. So from, on the first day, if the stock starts dropping below its volume-weighted average price, I don't want anything to do with it, because it's telling me that the sellers are in control of the stock. If you look at a couple of the recent IPOs, you'll see, and put a volume-weighted average price from the IPO date, you'll see that it tends to really attract buyers. So pullbacks towards that volume-weighted average price are often a good place. And there you have Zoom. You can see how critical that red volume-weighted average price was, where it dropped below it in September, and then the buyers regained control in February, and it's been up and away since then.
Yeah, if you bought in February, you'd be pretty happy right now.
Oh, absolutely, yeah.
Here's another question. I'll take this one off the top. How much of the market rally is Fed-driven? And I'm just going to say substantially. I've followed the Fed for a long time here, and I watched in 2009 with disbelief at what was unfolding in the markets then. The Fed really launched Bazooka QE1 in March of that year, and we had an incredible rally off of that. Coincidentally, we have the lows in March off this year after the Fed doubled down, tripled down, quadrupled down on its QE measures and above and beyond that. So there are a lot of, not only the parallels between the macro situation between these times and 2009, but also in the chart. The charts from 2009 are eerily similar. So I use that as kind of a guidepost, and that's why I wouldn't be surprised to see the market rally substantially at different parts in this year. Not to say that it's going to be identical and that it's not going to be fraught with difficulties, but overall, there are a lot of parallels here that I think we need to listen to and be open to. As many reasons as there are to be bearish fundamentally right now, I think we really need to keep an open mind. And with the $10 trillion in central bank stimulus, the $8 trillion in fiscal stimulus, there's a lot being thrown at the wall right now. And that helps explain a bit of the disconnect between the real world and the economy, and then the stock market, which has just basically been doing gangbusters. So let's review the results of our last poll. And this was, what is the number one mistake traders make? No trading plan, that's about a third of you. Taking on too much risk, 15%. And then impulsive trading, 51%. And I think we've all done a little bit of impulsive trading. It can manifest itself in different forms. What are your thoughts on any of these? Not just impulse trading, but too much risk, no trading plan. What are your thoughts, Brian?
Impulsive trading. I mean, it's realistically, that's why I was happy to see that only 10% of the poll attendees today said that they find their ideas from social media, because people can really get manipulative and try to get you excited about buying a stock. So, always ask yourself, I say, two questions. Where does the stock come from, and where does it have the potential to go? One of the biggest mistakes I see personally, Jared, when people ask me, to look at a stock, is they'll want me to look at a stock and I look at it and it's up 20, 30% in the previous 2 days. Those are not normal types of moves, and that's chasing. That's FOMO, right? And FOMO is what drives a lot of these poll answers that you have here. So have a plan, stick to your plan, and have that backup plan, and just, kind of put the blinders on. If you have a plan, you'll miss some trades, but in the long run, it's going to work out best for you.
Yeah, and excuse me, it also kind of highlights the importance of filtering out the noise. I love Twitter as a news service, and I get a lot of ideas off of it, but you always got to shape them and put them within your own framework, because if you take somebody else's trade, you don't know all the parameters. A lot of times you're not going to get any kind of risk management. And I just want to kind of riff off that, and with the way the Robin Hooders have come to the market now. And personally, I think it's a great thing that we have new people coming into the market, especially during a difficult time. It seemed, a lot of the most popular trades on Robinhood have been some of the best performers. Right. It's unlikely to last. So what happens when the market regime changes, as it tends to do maybe every 6 months to 2 years? What then, Brian?
New participants are always a great thing for the market. And I see this debate that I don't understand about, it's going to end badly, and, they're taking all this risk they don't need to take. That's how you learn. That's how I learned. I couldn't imagine being in high school and having a cell phone and being able to buy $50 worth of a stock or whatever it is that you're able to start at today. It's an amazing resource, an amazing tool, and people have to let other people make their own decisions in the market. Take the risks. The market is about taking risk, but get yourself educated. And, whenever I see an idea, as I like to say, make the trade your own. It's okay to see an idea on the Robinhood Top 100 board or on social media and say, hey, that looks interesting to me. I'm not going to jump in and be impulsive, though. I'm going to make the trade my own by doing a little bit of research and figuring out where my stop is if it goes wrong, because some of these stocks that run up, 500% in a couple days, they come down even faster.
Yeah, we definitely saw that with Hertz. So we're going to take two more questions before we wrap here. First is, and I'll take this off the top to get your thoughts, Brian. This is from Ram from Atlanta. What is your opinion regarding 3 times leveraged ETFs? And I'm going to tell you, you've got to be careful with these guys. Anytime you're getting into an ETF, especially a leveraged one, you have to know what you're trading. You have to know how it's structured, because some of them, like the USO Oil Trust, that's structured as a commodity pool, so you have tax consequences that may surprise you. But in terms of the triple leveraged ETFs, it's possible for whatever it's representing. Let's say it's the price of crude oil. It's possible that the price of crude oil rises over time and that you lose money on your investment because it's recalibrated to 3 times whatever the daily movement is that day. And I don't have to get into all the particulars here, but just you have to know what you're trading. Brian, your thoughts?
Agreed 100%. I mean, I think a lot of people don't understand what it is that they're getting involved in. I saw today that, TVIX, double long volatility index is going to be delisted, yet they're still trading it, and it's just going to go away. So I think there's a lot of risks that people are taking that they don't understand. Know what you're trading, and realize also that you can't chart these things the way you do traditionally, not over the long term at least, because they have that declining asset value and they do lose value. If you look at any longer term chart of these triple leverage, even the long S&P ones, they don't end up going up at that triple rate due to that daily compounding that isn't present there.
Yeah, the people I've known, the professional traders I've known who have done well with those, they tend to be over very short swing trader time frames. Moving on here to the last question. It seems so many of the major stocks trading these days are amazingly overpriced, like Amazon, Wayfair, Tesla. Do you see these stocks holding their value and not crashing down anytime soon? I'm gonna take this first, and fair value is an interesting concept, but prices can deviate from it for long periods of time, and it's kind of like the old adage: the markets can remain irrational longer than you or I can remain solvent. So you can look at that as it trends over time, but as for shorter term time frames, it's not going to be as relevant, fair value, because it's not going to affect the stock price over the coming days, over the coming weeks. So it depends on your time frame. Last thoughts, Brian?
I've got to, agree with what you said, Jared. I mean, who are we to say that it's overvalued or undervalued when there's a bid right there you can sell it to at 1,100 for Tesla? Perception is reality in the market, and if there's enough people buying it, then that's fine. But our job isn't to predict what's going to happen next, but it's to anticipate the potential scenarios. If you're holding Tesla and you're concerned it's about to come crashing down, do what we spoke about 10 minutes ago. Understand where your stop is going to be. You're not going to sell it at the high. Only liars sell it at the high. Instead, understand where am I comfortable getting out because the trend might be breaking, and lock in your profits and don't have to worry about it after that.
Yeah, only liars sell at the high. There might be a few of those on Twitter. Brian, thank you for joining us. And thank you, all of our viewers, so much for joining us for our first inaugural webinar on Yahoo Finance Premium. I'm Jared Blikre, along with Brian Shannon, who you just met. We will be offering these regularly, and we look forward to having you join us again soon. So send us your questions and let us know what topics you'd like us to discuss in the next webinar.